Question 1. An investor sells 100 shares of stock at $50 per share. What is the settlement date for this transaction? A. Trade date, T. B. T plus 1 business day. C. T plus 2 business days. D. T plus 3 business days. Answer, C. T plus 2 business days. Most common stock and corporate bond transactions settle on the second business day following the trade date, T plus 2. This means that ownership of the securities and payment for them must be exchanged by the end of the second business day after the trade was executed. Understanding settlement cycles is crucial because it dictates when funds and securities are officially transferred, ensuring an orderly market. Always remember that the T refers to the trade date itself, not the settlement date. Question 2. Which of the following regulatory bodies is primarily responsible for enforcing federal securities laws and regulating the securities industry? A. Financial Industry Regulatory Authority, FINRA. B. Securities and Exchange Commission, SEC. C. Municipal Securities Rulemaking Board, MSRB. D. Federal Reserve Board, FRB. Answer, B. Securities and Exchange Commission, SEC. The Securities and Exchange Commission, SEC, is the primary federal regulatory agency tasked with protecting investors, maintaining fair and orderly markets, and facilitating capital formation by enforcing federal securities laws. While FINRA and MSRB are important self-regulatory organizations, SROs, that write rules and enforce compliance among their members, they operate under the oversight of the SEC. Knowing the SEC's foundational role is key to understanding the entire regulatory structure of the securities industry. Question 3. A customer opens a cash account and wants to purchase mutual fund shares. What is the maximum percentage of the purchase price that the customer must pay? A. 25%. B. 50%. C. 75%. D. 100%. Answer, D. 100%. In a cash account, customers are required to pay 100% of the purchase price for any securities bought. Unlike margin accounts, which allow borrowing to finance a portion of the purchase, a cash account prohibits the use of borrowed funds for trades. The core concept here is that a cash account means no credit or leverage is extended by the broker-dealer. Always remember that cash account implies full payment is due. Question 4. All of the following are typically considered investment companies except A. Mutual funds. B. Exchange-traded funds, ETFs. C. Unit investment trusts, UITs. D. Hedge funds. Answer, D. Hedge funds. Investment companies are regulated entities that primarily engage in the business of investing in securities, including mutual funds, exchange-traded funds, ETFs, and unit investment trusts, UITs. Hedge funds, while also pooling money for investment, are generally structured as private investment partnerships and are not subject to the same strict regulations under the Investment Company Act of 1940, making them distinct from the typical investment company types. Understanding the different classifications of investment vehicles helps clarify their regulatory oversight. Question 5. Which type of risk is unique to a specific company or industry and can be mitigated through diversification? A. Market risk. B. Interest rate risk. C. Systematic risk. D. Non-systematic risk. Answer, D. Non-systematic risk. Non-systematic risk, also known as business risk or specific risk, is the uncertainty inherent in a company's or industry's operations that can be reduced or eliminated by diversifying investments across various companies or industries. In contrast, systematic risk, like market risk or interest rate risk, affects the entire market or economy and cannot be diversified away. The key takeaway is that diversification is an effective strategy against risks unique to individual securities. Question 6. A registered representative receives an unsolicited order from a customer to purchase shares of a highly speculative stock that the representative believes is unsuitable. Which of the following actions is most appropriate for the representative? A. Decline the order and refuse to execute the trade. B. Execute the order but document that it was unsolicited and the representative's concerns. C. Advise the customer to reconsider and suggest an alternative investment. D. Report the customer to FINRA for making an unsuitable investment choice. Answer: B. Execute the order but document that it was unsolicited and the representative's concerns. When a customer places an unsolicited order for a security, the registered representative is generally obligated to execute the trade, even if they believe it is unsuitable, provided the customer has the financial capacity. However, the representative should always document that the order was unsolicited and that they informed the customer of their concerns regarding suitability. While giving advice, C, is good practice, refusing the order, A, is typically only done in cases of fraud or regulatory violations, and reporting the customer, D, is not appropriate for suitability concerns on an unsolicited trade. Question 7. Under FINRA rules, how long must most customer complaints be retained by a broker-dealer? A. 1 year. B. 3 years. C. 4 years. D. 6 years. Answer: C. 4 years. FINRA rules require broker-dealers to retain written customer complaints, along with the action taken by the firm, for a period of 4 years. This retention period is crucial for regulatory oversight and investigations, allowing FINRA to review how firms handle disputes and ensure compliance with industry standards. Remembering the specific record-keeping timeframe is important for understanding broker-dealer obligations. Question 8. Which of the following describes a bull market? A. A period of sustained decline in security prices. B. A period of sustained growth and rising security prices. C. A market characterized by high volatility and unpredictable swings. D. A market where investors are primarily selling short. Answer: B. A period of sustained growth and rising security prices. A bull market refers to a financial market where prices are rising or are expected to rise, leading to investor optimism and increased buying activity. Conversely, a bear market describes a period of declining prices. Understanding these fundamental market terms is essential for interpreting general market sentiment and economic conditions. Think of a bull charging upwards with its horns as a way to remember rising prices. Question 9. An investor holding an American Depositary Receipt, ADR, is exposed to which of the following risks? A. Reinvestment risk. B. Inflation risk. C. Currency risk. D. Liquidity risk only. Answer: C. Currency risk. American Depositary Receipts, ADRs, are certificates issued by a U.S. bank that represent shares of a foreign stock. While ADRs allow U.S. investors to trade foreign stocks in U.S. markets, the underlying foreign stock is still denominated in its home currency. Therefore, the value of the ADR can be significantly affected by fluctuations in the exchange rate between the US dollar and the foreign currency, exposing the investor to currency risk. Question 10. Which of the following best defines the term bid price in a securities quote? A. The highest price a buyer is willing to pay for a security. B. The lowest price a seller is willing to accept for a security. C. The price at which the last trade occurred. D. The midpoint between the highest bid and lowest ask. Answer: A. The highest price a buyer is willing to pay for a security. In a securities quote, the bid price represents the highest price a buyer is currently willing to pay for a security. Conversely, The ask price, or offer price, is the lowest price a seller is willing to accept. The difference between the bid and ask is known as the spread. Understanding these terms is fundamental to comprehending how securities are bought and sold in the market. Question 11. Which of the following statements is true regarding the taxation of municipal bonds? A. Interest income is always taxable at the federal level. B. Interest income is always tax-exempt at the federal level. C. Interest income is generally tax-exempt at the federal level and may be tax-exempt at the state and local levels if the investor resides in the issuing state. D. Capital gains on municipal bonds are always tax-exempt. Answer: C. Interest income is generally tax-exempt at the federal level and may be tax-exempt at the state and local levels if the investor resides in the issuing state. A key feature of municipal bonds is that the interest income they generate is typically exempt from federal income tax. Additionally, if the bondholder resides in the state or municipality that issued the bond, the interest income may also be exempt from state and local income taxes, providing what is known as triple tax-exempt status. This tax advantage makes municipal bonds attractive to investors in higher tax brackets. Question 12. What is the primary purpose of the Securities Investor Protection Corporation, SIPC? A. To regulate broker-dealers and their registered representatives. B. To protect customers against losses resulting from the bankruptcy or insolvency of a broker-dealer. C. To provide insurance for bank deposits. D. To enforce insider trading laws. Answer: B. To protect customers against losses resulting from the bankruptcy or insolvency of a broker-dealer. The Securities Investor Protection Corporation, SIPC, protects customers against the loss of cash and securities held by a broker-dealer if the firm fails, up to $500,000 per customer, including up to $250,000 in cash. SIPC does not protect against market losses or poor investment decisions, nor does it regulate firms. Think of SIPC as a safety net specifically for brokerage account assets in case the broker-dealer itself goes out of business. Question 13. Which of the following would be considered an access person under the Investment Advisors Act of 1940 and be subject to reporting personal securities transactions? A. A compliance officer who has access to non-public information regarding client transactions. B. A receptionist who handles general administrative duties and has no access to investment information. C. A marketing professional who promotes the firm's services but does not make investment decisions. D. A third-party vendor providing IT support with no access to trading data. Answer: A. A compliance officer who has access to non-public information regarding client transactions. An access person under the Investment Advisors Act of 1940 is typically a supervised person of an investment advisor who has access to non-public information regarding client purchases or sales of securities, or who makes investment recommendations to clients, or whose job function requires them to obtain such information. Such individuals are subject to strict rules, including reporting their personal securities transactions to prevent conflicts of interest and insider trading. The core concept is about who has direct insight into client trading or recommendations. Question 14. What is the definition of a control relationship in the context of securities transactions? A. A situation where a registered representative and a customer are related by blood or marriage. B. A situation where the municipal bond dealer, or an officer or employee of the dealer, is in a position to influence the issuer of the municipal bond. C. A relationship where one broker-dealer owns more than 50% of another broker-dealer. D. A situation where a customer has discretionary trading authority over their account. Answer: B. A situation where the municipal bond dealer, or an officer or employee of the dealer, is in a position to influence the issuer of the municipal bond. A control relationship exists when a municipal bond dealer, or an officer or employee of the dealer, is in a position to influence the issuer of the municipal bond, such as holding a seat on the issuer's board or being a significant shareholder. If such a relationship exists, it must be disclosed to customers before confirming a transaction to ensure transparency and avoid potential conflicts of interest. This disclosure is crucial for investor protection in the municipal bond market. Question 15. A customer writes an equity call option. This investor's maximum potential gain is A. Unlimited. B. The premium received. C. The strike price minus the premium. D. The difference between the strike price and the market price. Answer: B. The premium received. When an investor sells, an equity call option, they receive a premium up front. This premium is the maximum profit they can achieve, as the buyer of the call option will only exercise if the stock price rises above the strike price, at which point the writer begins to incur losses. The core concept here is that writing an option involves taking on significant risk for a limited potential reward equal to the premium collected. Question 16. All of the following are primary functions of a broker-dealer's operations department except A. Handling the transfer and delivery of securities. B. Maintaining customer account records. C. Executing trades on behalf of clients. D. Processing customer cash and security movements. Answer: C. Executing trades on behalf of clients. While the operations department supports many functions, the execution of trades on behalf of clients is primarily the responsibility of the trading or sales department, handled by registered representatives or traders. The operations department focuses on the back-office functions such as settling trades, transferring securities, maintaining records, and processing payments and deliveries. Knowing these departmental distinctions helps clarify the different roles within a broker-dealer. Question 17. Which of the following types of orders is executed immediately at the best available price? A. Limit order. B. Stop order. C. Market order. D. Stop limit order. Answer: C. Market order. A market order is an order to buy or sell a security immediately at the best available current price. It prioritizes immediate execution over price, meaning the investor will get the trade done quickly but the exact price is not guaranteed until execution. In contrast, a limit order specifies a maximum buy price or a minimum sell price, prioritizing price over immediate execution. Question 18. Under normal circumstances, when must a customer receive a new account form from a broker-dealer for signature? A. Before the first trade is executed. B. Within 30 days of opening the account. C. Promptly after the first trade is executed. D. Annually, along with other account statements. Answer: B. Within 30 days of opening the account. While broker-dealers typically try to get a signed new account form as soon as possible, FINRA rules require that customers receive a copy of the new account form for verification and signature within 30 days of opening the account. This ensures that the customer reviews and confirms the accuracy of the information collected by the firm. Periodically, firms must also send account statements to customers for review. Question 19. An investor who sells shares of stock that they do not own, hoping to buy them back later at a lower price, is engaging in which of the following? A. Long sale. B. Covered call. C. Short sale. D. Day trading. Answer: C. Short sale. A short sale occurs when an investor sells securities they do not own, typically by borrowing them through their broker-dealer, with the expectation that the price of the securities will fall. The investor then plans to buy the shares back at a lower price in the future to return them to the lender, profiting from the decline. This strategy is distinct from a long sale, where an investor sells shares they already own. Question 20. Which of the following statements is true regarding a bond trading at a discount? A. Its coupon rate is higher than its yield to maturity. B. Its yield to maturity is lower than its coupon rate. C. Its yield to maturity is higher than its coupon rate. D. It is trading above its par value. Answer: C. Its yield to maturity is higher than its coupon rate. When a bond trades at a discount, meaning its market price is below its par value, it signifies that its coupon rate, the fixed annual interest payment, is lower than the prevailing market interest rates or its yield to maturity, YTM. Therefore, to make the bond attractive to new investors, its yield to maturity must be higher than its coupon rate. This relationship holds true because the investor will not only receive the coupon payments but also a capital gain at maturity when the bond is redeemed at par. Question 21. Which of the following is a primary role of the Municipal Securities Rulemaking Board, MSRB? A. To regulate the issuance of municipal securities. B. To enforce MSRB rules on municipal bond dealers. C. To write rules for municipal securities firms and professionals. D. To buy and sell municipal bonds in the secondary market. Answer: C. To write rules for municipal securities firms and professionals. The Municipal Securities Rulemaking Board, MSRB, is an independent self-regulatory organization that creates rules for municipal securities firms and professionals, including broker-dealers and municipal advisors. While the MSRB writes the rules, it does not enforce them. Enforcement falls to FINRA for broker-dealers and the SEC for municipal advisors. Understanding this distinction, that the MSRB is a rulemaking body and not an enforcement body, is crucial. Question 22. What is the primary risk associated with a fixed annuity during the accumulation phase? A. Market risk. B. Interest rate risk. C. Purchasing power risk, inflation risk. D. Liquidity risk. Answer: C. Purchasing power risk, inflation risk. A fixed annuity during the accumulation phase offers a guaranteed interest rate, meaning the principal and interest credited are secure from market fluctuations. However, the primary risk is purchasing power risk, also known as inflation risk, because the guaranteed fixed interest rate may not keep pace with the rate of inflation, leading to a decrease in the purchasing power of the accumulated funds over time. Variable annuities, in contrast, expose investors to market risk. Question 23. A customer opens a new account and wants to receive all communications electronically. What must the broker-dealer ensure to fulfill this request? A. The customer has a valid email address on file. B. The customer provides written consent to receive electronic delivery. C. The broker-dealer has a secure website for document access. D. The customer pays an additional fee for electronic delivery. Answer: B. The customer provides written consent to receive electronic delivery. For a broker-dealer to send communications, such as account statements, confirmations, and prospectuses, electronically, the customer must provide affirmative written consent. This requirement ensures that the customer understands and agrees to receive important documents digitally instead of through traditional mail. Simply having an email address, A, or a secure website, C, is not sufficient without the customer's explicit consent. Question 24. What is the main characteristic of a common stock that distinguishes it from preferred stock? A. Common stock pays a fixed dividend, while preferred stock pays a variable dividend. B. Common stock has voting rights, while preferred stock typically does not. C. Common stock has a prior claim on assets in liquidation, while preferred stock does not. D. Common stock has a fixed maturity date, while preferred stock is perpetual. Answer: B. Common stock has voting rights, while preferred stock typically does not. The primary distinction between common stock and preferred stock lies in voting rights and dividend payments. Common stockholders typically have voting rights, allowing them to elect the board of directors and vote on corporate policy, while preferred stockholders generally do not. Preferred stock, however, usually pays a fixed dividend and has a senior claim on assets and earnings compared to common stock in the event of liquidation. Question 25. Which of the following entities issues a prospectus? A. The Securities and Exchange Commission, SEC. B. A broker-dealer selling the securities. C. The issuer of the securities. D. FINRA. Answer: C. The issuer of the securities. The issuer of the securities, such as a corporation offering new shares or bonds, is responsible for preparing and filing the prospectus with the SEC. The prospectus is a legal document that provides detailed information about the investment offering to potential investors, outlining the company's financial condition, business operations, and the risks associated with the investment. Broker-dealers then distribute this prospectus to prospective purchasers, but they do not issue it.